So here's something you might not know. There are submarkets inside the total stock market. These submarkets make up the stock market as a whole. Research done by Gene Fama, a recent recipient of the 2013 Nobel Prize in Economics and Finance, and his research partner, Ken French, shows that total stock markets is really an amalgamation of markets as a whole. So understanding how to invest in these markets is an intellectual framework for growing and protecting capital. So here's an example. The Center for the Research of Security Prices, their database, tracks over 32,000 publicly traded stocks that represent the entire stock market from the inception of the stock market in 1926 to today. So if you'd invested $1 in this whole market represented by the CRISP database, it would have grown to $6,028 at the end of 2017. That's a 9.9% compounded return. A submarket is the S&P 500, only 500 of the 7,800 stocks. Using fair market value as the measure, $1 invested in the S&P submarket would have grown to $7,347 over that same time period. That's a 10.2% return. So this difference, 0.3%, $1,319, shows how a submarket can provide improved performance when compared to the total market over the same period of time. Dimensional Fund Advisors, one of the largest mutual fund families in the world, was formed in 1981 to explore the dimensions that exist within the total market compared to the S&P 500. So using the research of Fama, as well as Miller, Markowitz, Sharp, and Merton, the other 4 Nobel Prize recipients in this subject area, Dimensional Funds has identified several submarkets that add value. These are referred to as anomalies. Now, 3 of these anomalies are the cornerstone of their investment strategy and also ours here at Wealth Teams. So do me a favor, take out a piece of paper and draw a square like this one. Now this square represents 7,800 domestic stocks that Dimensional has determined meets their stringent criteria for growing and protecting capital. Now if we look closer at these 3 anomalies, we'll find that they are based not only on the size of a company, which is capitalization, but also on value and profitability. Capitalization can be determined simply by multiplying the share price of a stock times the number of shares held by investors. So draw a line horizontally now through the middle of the square, and we'll call this the median. And if we rank all these stocks from the largest to the smallest in capitalization, we can put the larger stocks above the line and the 50% smaller stocks below the line. And so we'll call this large cap, small cap. So looking at the CRISP database for these particular stocks, $1 invested above the line, the large cap, grew to $5,714 from 1926 to 2017. Small cap grew to $30,560 over that same period. This is a significant difference. But how often does that happen? So further research done by Dimensional determined 57% of the time small cap below the line outperformed large cap above the line on a 1-year rolling data basis. Note, however, that small cap has delivered higher aggregate returns over any 1-year period, but there's still a 43% probability that large cap will outperform small cap. There are 1,076 1-year periods from January 26 to December of 2017. Now, if we instead look at this on a 5-year rolling basis, small cap outperforms large cap 64% of the time. So go out a little bit longer and small cap outperforms large cap more frequently. If we go on a 10-year rolling basis, this percentage increases to 72%. Now, while there is a high probability these anomalies will provide additional returns, we still diversify our portfolios among the whole market but we weight towards the anomaly. The second anomaly that DFA tracks measures the net worth of a company, assets minus liabilities. This value measure is called book value. So if we divide the book value of a company by the capitalization value, the fair market value, the ratio can be compared for every stock in the database. Book value essentially reflects the value of buildings, inventory, machinery, those types of things. The higher this ratio, the closer the liquidation value is to the fair market value. So a ratio of 1 means that the stock price is virtually equivalent to the liquidation value of a company. Companies with a lot of physical assets have a larger book value than companies with relatively few assets that maintain intellectual property and computers. Companies with large ratios are called value companies. Technology companies, on the other hand, whose assets stem primarily from intellectual rights, patents, and so on, have a lower ratio and are known as growth companies. So let's take our square and draw a line vertically down the middle. Now we have 4 equal quadrants, and based on the 2 anomalies, large growth and large value, we have above the line and small growth and small value below the line. Now the large value box, $1 has grown to $15,699 over the last 90 years. Most people can't guess how much small value has grown to over that same period, but it's $83,387, nearly a 14% compounded return. And this 4% differential is the main reason why people like that asset class. But the difference is that it has much higher volatility, which is called risk. So what does this data teach us? Research has shown companies with high book to market ratios have historically outperformed growth companies with smaller ratios. On a 1-year rolling average, if we look at value and growth, value beats growth 61% of the time. On a 5-year roll, it's 75% of the time, and on a 10-year rolling basis, it's 84% of the time. The evidence makes it very clear that value companies have a higher probability of providing a higher return to the investor than growth companies. So now let's look at the last anomaly. DFA measures one that's called profitability. Logically, it makes sense, doesn't it, that companies with high profits would outperform companies with low profit. So profitability is really measured across all industries by normalizing the reported earnings every quarter. Now, based on the research, companies with above median profits outperform those with below median profits 85% of the time when using that 1-year rolling average. If you go to the 5-year rolling average, it jumps up to 92%, and beyond 10 years, it's 100%. So companies with high profitability will outperform below median profitable companies 100% of the time. Now that makes sense, doesn't it? A fully diversified portfolio with a long time horizon would be wise to heed this research and weight the portfolio to take advantage of these anomalies. This is what we do at the Wealth Teams Alliance. We identify how much to weight each of the boxes that I showed you by using the efficient frontier methodology that we've adapted. It keeps the risk the same as if you'd invested in the whole square without making any distinctions between the submarkets. If you want to know more about how this is done, there's a video specifically explaining the efficient frontier. But let me summarize it for you just real quickly. Using the DFA funds specifically created to track these 3 anomalies, capitalization, net worth, and profitability, we test the various combinations in 5% increments using return and volatility. So there's 5 funds that we use in our U.S. portfolio, and these 5 funds create 3,125 combinations of risk and return. Now, according to the theory, only one is optimal for the amount of risk that you're willing to assume. So we can build a portfolio that allocates our clients' capital to these funds in proportion to their historic expected return. These DFA funds only invest in large cap growth, large cap value, small cap growth, and small cap value. And we also factor in high profitability to weight the portfolio towards those stocks. So once you've made a decision to invest in the market, you have at least 4 ways to do this. First, you can ignore the research and invest in stocks you think will outperform the market. Okay? Or second, you could invest in the market as a whole, but invest solely on capitalization, putting most of the capital in the highest valued stocks. This is the way most brokers do it, and the S&P 500 is an example of this. A third method would be to invest equally in each of the 4 anomalies. Interestingly, this is how Harry Markowitz said he invested. He paid no attention to the value growth anomaly or to profitability. The fourth method is the way we do it here at Wealth Teams Alliance. We allocate to each of the anomalies, but we weight the portfolio based on risk and time horizon. So using this efficient frontier methodology, we try to identify the optimum allocation based on the expected return. There are no guarantees this method will deliver results better than investing in the market as a whole, paying no attention whatsoever to the submarkets, and in fact can perform worse. But we feel the historic evidence is strong enough that those weightings should not be ignored. So how much improvement has weighting the anomalies actually delivered? We just saw earlier that if you invested $1 in 1926 in the S&P, your dollar would have grown to $7,347. But if we took that same dollar and we invested it in the anomalies with essentially the same level of risk over the same amount of time, it would have grown to $24,245. That's a 3-fold increase over 90 years, and it demonstrates the importance of having a long-term outlook with an intellectual framework. Research has shown these anomalies have historically added additional return to the portfolios. However, remember, markets are random, so there are no guarantees. So what's the lesson? As an investor, you need to determine your time horizon and your risk tolerance. And once you've determined these 2 factors, we can then look at various combinations of market-based funds to see which approach makes the most sense for you. Remember, markets go up and markets go down. That axiom has been true for centuries, dating back to the tulip bubble in 1637. Do you remember that? This was when crazed investors sought huge profits from holding and trading tulips. One of the victims was Sir Isaac Newton, the famous physicist. And when the tulip bubble burst, many investors lost fortunes. And this has been happening to investors ever since. Or should I say gamblers and speculators. See, long-term investors do not typically chase tulips or internet bubbles or any other bubble for that matter. They diversify and they trust the markets. So paraphrasing Warren Buffett, he said, and some of you might remember this, select an intellectual framework, a defensible process, and then protect yourself from making emotional decisions that will destroy your framework and your process when the markets get bumpy. We at the Alliance are dedicated to following this intellectual process and helping our clients hold fast when that ride gets bumpy. We believe in both sides of Buffett's exhortation and admonition. So if you want to learn more about the Wealth Teams Alliance and how we can help you protect your capital, contact us for an efficient frontier analysis of your portfolio.